In today's video, I'm going to help you understand how capital gains impact the taxes you pay on the rest of your income. Hey everybody, I'm James Conole, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Now, most of us generally understand how taxes work. We have a progressive tax system, which means the first dollars that you earn are taxed at a lower rate than future dollars that you earn. If you take a look at the screen here, you can see exactly what I'm talking about. What you'll see, and these are tax rates for 2022, just federal tax rates, state tax rates are separate, but what you can see here is the first amount of taxable income that you have. So the first amount of taxable income, for example, from 0 to $20,550, that's taxed at 10%. Then the next amount, from $20,550 into $83,550, that's taxed at 12%. And what starts to happen is you get taxed at 10% first, then 12% on dollars above that, and then 22% on dollars above that. And what starts to happen is the more you earn, those first dollars are still taxed at the same amount, but future dollars get taxed at higher and higher rates. That's how ordinary income taxes work. Many of us also generally understand how capital gains taxes work. What you can see here is if you're married filing jointly and your income is under $83,350, you pay taxes at a 0% rate. If your income is between, your taxable income is between $83,350 and $517, you pay taxes at 15%, and then finally you pay at 20% if your income's over a certain threshold. So what we see is ordinary income is taxed on one schedule, capital gains are taxed on another schedule. The question is, will capital gains increase the taxes I pay on my ordinary income? The answer is no. So thankfully, as you're realizing capital gains, it's not actually going to impact the taxes you pay on your ordinary income, and let's look at an example to show you how this actually works. Let's assume that your adjusted gross income, which for simplicity's sake is the income that you earn minus any deductions for 401k or 403b contributions, but let's assume that your adjusted gross income, AGI, is $100,000, and let's assume that you are married filing jointly for your taxes. Well, you can deduct something. You can either deduct your standard deduction or your itemized deduction. Your itemized deduction is a combination of state taxes up to $10,000. It's a combination of mortgage interest, charitable giving, healthcare expenses over certain thresholds. And if all of those things add up to more than your standard deduction, then you can itemize. If not, you just take a standard deduction. And the standard deduction for 2022 for married filing jointly is $25,900. Let's just round that to $26,000 to make this nice and easy. So your AGI is $100,000. Let's assume $26,000 is your standard deduction. What that means is your taxable income, so the income you're actually paying taxes on, is $74,000. So we take this number, and if we go back to this other page here, on your ordinary income taxes, what we see is you're gonna fill up this entire bracket here. The first $20,550 of taxable income, you're paying tax at 10%. Well, you have $74,000 of taxable income. So once you pay taxes on the first $20,550, then you go here. What you see here is at $74,000, you're not going to exceed the 12% bracket. Means some of your dollars are taxed at 10, some of your dollars are taxed at 12, and your tax rate is going to be the blended amount of those two, minus of course the standard deduction, which is essentially a 0% tax rate on your first $25,900. Now, let's go back here and assume that you have the same exact adjusted gross income, same exact everything, but you maybe sold a rental property this year. And let's assume that with that rental property, you earned $100,000 of long-term capital gains. Now, it's important that these are long-term. A short-term capital gain, that is always taxed at your ordinary income rates, and your ordinary income rates are higher than your capital gains rates. So as long as you've held the investment for over a year, you will get long-term capital gain treatment. So if we look at this again, now all of a sudden, your taxable income isn't $74,000, it's $174,000. So if we go back to our brackets here, the good news is this. Even though $174,000 is your new taxable income, it's not actually doing anything to push you into a higher bracket here. This stays exactly where it is because your ordinary income is still this $74,000. That additional $100,000, that starts to get taxed here. The good news is this. If your taxable income is under $83,350, again, think of taxable income, going back here, as your adjusted gross income minus your standard deduction or your itemized deduction. That gives you your taxable income. If your taxable income for this year is under $83,350, you pay 0% on long-term capital gains. So a quick side tip for everyone, if you know your income's under there, you can actually realize some long-term capital gains on purpose. It's called tax gain harvesting and pay $0 in federal income taxes as long as you're not exceeding that $83,350. Be mindful of state taxes, but at the federal level, you'd be in the 0% bracket. So what this is doing here, this extra in our example, $100,000, this is going to be taxed on this rate, which means you're going to get some at the 0% rate. So the amount between $74,000 and $83,350, that's taxed at 0, and then the amounts above that is taxed at 15. So the good news for a lot of investors, when they're worried about we're selling a property or we're selling stocks, we're selling a business, yes, you're going to be taxed, but it's not actually driving your ordinary income rates any higher. That's completely going to be on the capital gains side. Now, one thing to note is in addition to federal capital gains, you have to be mindful, of course, of state capital gains. Some states tax capital gains differently. Some states treat capital gains just like ordinary income. California, where I live, that's how they treat it. There's no difference between capital gains and ordinary income. They're all taxed at the same rate. On top of that, you have what's called a net investment income tax. So this is called the Obamacare surcharge. 3.8% extra tax if you're exceeding $250,000 of adjusted gross income. That extra 3.8% tax will be added on top of this. So those are just a couple of side points, but when you're looking at the federal tax brackets, it's important to understand how ordinary income is taxed, how capital gains is taxed, and it does not necessarily impact one another. Now here's what capital gains does impact. It does impact your adjusted gross income. So your adjusted gross income is a combination of things like salaries, rents, it's a combination of capital gains, all the different income sources you have. That matters because your adjusted gross income determines things like eligibility for IRAs or Roth IRAs. It determines what your IRMA surcharges might be. It determines your ability to take certain deductions or exclusions or not take them. So there are other nuances that you do have to take into account with capital gains, and capital gains will push your adjusted gross income higher. But for example, if you're in a 24% bracket and you're on the edge of should I sell this stock or not sell this stock because I don't want to be pushed up into the 32% bracket, the good news is as long as those gains are long-term, it's not going to push you into a higher bracket on the ordinary income side. It will certainly be a capital gain that you will still pay taxes on, but it's not going to impact your ordinary income. Where I commonly hear concerns around this is, well, what about the impact on Roth conversions? If I do a Roth conversion and realize capital gains, is that going to be impacted? No. It will mean higher total tax, but they're taxed on different schedules, and no amount of long-term capital gains will push you into higher ordinary income tax brackets. So it is still important to have an overall strategy that helps you understand, should you focus on realizing capital gains? Should you focus on things like Roth conversions or accelerating income? Should you be focused on something else? But when you start to understand the landscape of taxes and how it impacts everything, it's good to know how capital gains work, how ordinary income works, how it impacts other things like IRMA surcharges, Social Security provisional income, and more. But understand at the end of the day, higher capital gains, higher long-term capital gains will not lead to higher ordinary income. Now, speaking of things like Roth conversions, if you're wondering how does this fit into Roth conversions and what Roth conversion strategy should I implement, be sure to check out the video above to learn more. Once again, I'm James Conole, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.